And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement future. He is president and founder of McIntire Retirement Services. Always a pleasure to be joined by Chris McIntire. Chris, we hear about the excitement daily of the stock market, the movement, the growth that's available, the volatility that is there, and always a potential. But today's program focuses on what is considered to be a more stable and steady type of investment option, which is bonds or bond funds or the fixed income side of the portfolio. We don't hear nearly as much about it because it's not that exciting or not as exciting, right?
That's right. And you think you would because the bond market is like three times the size of the stock market. But as you know, Peter, the latest craze is everything AI and what's the next thing I'm going to make 300% on. And so bonds are certainly play a more boring role in a general portfolio, especially for, those who are younger. You probably don't have a whole lot of use for the bond side of things in all reality. As you get older and transition into retirement, you're looking for a reliable income stream, some, little less excitement. So, we live up here near Cedar Point Amusement Park, and, you got those roller coasters with some steep hills in them, and as you get older, you want to level out those hills. You're okay with a little bit of that ride, get that funny tummy feeling coming over the hill, but you don't want that sudden drop.
Well, I know the roller coasters at Cedar Point are pretty wild, but the stock there for Cedar Point for a long time paid out a pretty fantastic dividend as well. So the stock side, the equity, can produce an income, but the stock market makes the headlines, Chris. The bond market makes the income. Are you seeing that there is still a meaningful place in a retirement portfolio for bonds or bond funds or fixed income?
Yeah, without a doubt, Peter, gotten some pretty competitive interest rates after the 2022 cycle of increasing rates. Heck, back then we were buying, CDs at 5%. So, bonds and all those interest rates have picked up quite nicely. So they certainly still play a role in a portfolio because I think today, if we were going to log in and look at the 10-year Treasury, the 10-year U.S. government bond, I think those yields are about 4.6 to 4.7%. Well, that's not a bad rate of return, right? Backed by the U.S. government. And, we can make a joke about that too if we want. But
We probably will get into treasuries here in just a moment, Chris. One of the subsets, one of the types of fixed income that is available. But what I always appreciate about our conversations, Chris, is that you've got access to the full spectrum of the financial world. You can help us better understand and review and evaluate the merits, the appropriateness of all of the financial tools out there. So today, going to talk about the income generating component of a portfolio, fixed income, bonds, bond funds, other alternatives that might be out there, including those treasuries. But ladies and gentlemen, if you've got questions about how to appropriately and properly structure a portfolio for your situation, for your needs and your future goals, pick up the phone and give Chris McIntire a call, 419-332-0532, 419-332-0532. They do always offer a complimentary initial review, conversation, and game plan for retirement design, getting your game plan for retirement put together and structured. If you'd like to do that, take them up on that valuable offer and opportunity. Again, the number 419-332-0532, 419-332-0532. So Chris, I guess let's first back up from a 30,000-foot view. What exactly is meant when we hear the term fixed income?
yeah, so fixed income is, I'm going to get a set rate of payments coming out of it. Okay. And if we're talking about bonds, we're talking about interest then. Okay. And there are, different types of bonds that can generate that income, like we mentioned, treasuries, corporate bonds, and high yield bonds. So depending on the amount of risk you want to take within the bonds, that income is also going to vary depending on the type of selection that fits what you're looking for.
So there, you mentioned risk. So just because we're talking about bonds or fixed income does not mean we are absent of risk with this particular tool or this investment selection.
Yeah, exactly. And people my age are going to remember a company called Enron. That was a big, huge energy company, and they went bankrupt. Hey, well, the Enron stock and the Enron bonds basically get wiped out in that. So, you have different types of risk. Typically, with government bonds, you don't necessarily have the default risk because you have the taxing authority of the government. We live right here. I'm right near the Ohio Turnpike. They issue bonds to finance turnpike operations if they're going to do massive improvements or something, and that gets paid back by the tolls that we pay. Okay. We go into a corporate bond then from a major corporation, let's say investment grade bonds. An investment grade means, highly unlikely that they're going to default. So a pension fund could buy them, a bank, an insurance company could also buy them as well. And so, yep, you've got a little closer on the default risk with that on the corporate bond. So you get paid a little bit more typically. And then if I can, Peter, I'm going to transition into the high yield bond market space where, kind of think in the energy markets, somebody's wanting to develop a new nuclear plant or, expand fracking operations in Texas or something. Certainly riskier there if the oil isn't there, right? They've been financing at 10 or 12%, for example. So default risk with high yield bonds is the greatest. Interest rate risk is the greatest on government bonds. If they raise interest rates in the future, your bond is going to go down in value, is what we mean.
Well, Chris, as I am in the stock market, if I buy a stock with a company, I'm part owner of the company. I hope the company appreciates in value. I hope the company is profitable. But a bond is not buying ownership. A bond is a loan of money, and a set interest rate is the repayment. So there is a distinct difference here between stock ownership or buying a bond, meaning making a loan, correct?
Yeah, absolutely. And at the classes that I teach here at Terra Community College and BGSU Firelands, when we host our classes there, I use General Electric stock as an example. Because would you rather own a GE bond paying 4% or a GE stock paying a 4% dividend? Okay. And there isn't a right or wrong answer. The GE stock can certainly go up in value, and GE could also increase the dividend rate. Okay. Where if you have a bond, right, maybe it's a bond that's going to mature in 10 years. You're going to get a set amount of interest rate and your money back guaranteed, under their claims paying ability, of course, at GE. The downside is the stock price could fall, okay, like it did back
It
in the
did.
early 2000s there, yet when Peter I forget his name, but when he left, the stock went down and they cut the dividend. So, you're certainly going to have more risk with a stock than you are in a bond from, a return of principal mentality.
But when we're talking about fixed income, we are really talking about income, stability, predictability, right? That is the reason why we would consider this side of the portfolio, which is why as we get closer to or even enter into retirement, it has been the conventional traditional wisdom, Chris, to move more toward fixed income as at least in part of our portfolio. Do you feel that that still holds true that as we get toward that retirement time that we should be moving more toward steadying the ship, more predictability, maybe more fixed income bonds or bond funds?
Yeah, and nowadays we have some other alternative type bonds. We call them structured notes that we utilize in client portfolios where, we're generating a higher rate of return and then also having some form of protection on the downside movement of the markets. There are covered call strategies, option strategies, which aren't technically bonds, but when we're talking about income generation, we utilize more things than just bonds that pay interest and stocks that pay dividends. We use some things that fit in between there. It makes a real nice complement to an overall income portfolio for sure.
Well, you've mentioned those treasuries and those structured notes, so we'll dive into some of these alternatives, Chris. But when I have actually used the term a couple times here already of bonds or bond funds. Is there a distinct difference between a bond or a bond fund in a portfolio?
Yeah, without question, so a bond means I bought one bond from, the Whirlpool Corporation. I'll just use that for an example. It's right down the street. Okay. Versus buying a Vanguard total bond mutual fund that has bonds of all different shapes and sizes, durations, do they have some international bonds in them as well, some domestic bonds, some treasuries. So much more diversification in a bond fund than owning an individual bond itself.
Well, so Chris, do you think that adage of the 60-40 portfolio or 70-30 portfolio and moving more conservative is still the way that retirement portfolios should be structured? I know I sort of asked that already and you agreed, but talked a little bit about other alternatives. But
Yeah.
is it wise for a retiree to consider moving away from the stock market at a certain point in time?
Yeah, and 73 is kind of a magic year right now where there is a forced distribution on those retirement accounts, okay? And, so sometimes we'll structure the portfolio different so that, we're using some of our, in our case, the higher yielding notes, structured notes that we get that, can pay out 10 to 12% in interest and allocate enough money into that piece to generate that required minimum distribution. And then with the rest of the portfolio utilize stocks and that traditional bond pieces, like that 60-40, if you will. So, in today's, 2026 availability of different types of investment pieces, that's what's nice about, working with the fiduciary side and the fee-based investment management piece that we have is, we have access to lots of different types of investments that aren't in a traditional 401k, if that makes sense.
Well, again, we're talking with Chris McIntire, president and founder of McIntire Retirement Services. If you've got questions, feel free, be in touch. Pick up the phone, give a call, 419-332-0532, 419-332-0532. Chris, you mentioned the risk of bonds, and you specified a company I think that many of us have heard of with Enron, but it's more than just one company potentially having risk. The entire bond market can also have risk. And we can think back as recently as 2022 to when bonds and fixed income had one of their worst years on record. So, should we rely exclusively on bonds or bond funds or traditional fixed income for the side of the portfolio that we need to generate income from?
Well, yes, obviously diversification is a key factor here in stability and reliability of a portfolio's performance. And when you deal generally in that retirement market, people want that type of peace of mind. So, in 2022, for example, they raised interest rates 11 times in a row. Okay, so why did my bond portfolio perform so badly? Well, you might have had a portfolio that had bonds that were paying 3% interest, and at the end of 2022, I could buy new ones paying 5.5 or 6% interest. So why would I want to spend money on bonds paying less interest when I can, for the same money, I can buy bonds paying a higher interest rate? So the bonds that are in your portfolio have to be sold, lower in value to generate some sort of interest to bump up the yield, if you will. So big difference between the interest rate and the yield on a bond as well.
And I'm not asking for a crystal ball here, Chris, but I've heard some indication that the Fed may even be talking about or considering raising interest rates again. So is this something that I would need to worry about here in our current day and time, that if interest rates rise, my fixed income and bond values could fall?
It's certainly worthy of consideration, Peter. I don't think we're looking at 11 interest rate increases, but we've been north of that 3% range on inflation, and the Federal Reserve's target is 2% or less. And so they may, they just passed on it here recently, just like last week, they passed on an interest rate increase. And I think they're, and again, when they talk about a lot of things, they're discounting the price of oil and energy because it's so volatile in our inflation numbers. I think inflation for a real person spending money is probably more than 3%.
Sure.
Yeah, so and that's why we look at other alternatives than just the traditional bond portfolios. Those structured notes that we utilize, can help offset that. Some covered call strategies, blend in very nicely to get that diversification, in case of rising interest rate environment. And if you want to counter rising interest rates, then you buy shorter term bonds where you're deflecting some of that interest rate. That means when your bonds mature, hopefully they're going to mature at a higher and you reinvest at a higher interest rate. So stay shorter term versus longer term in a rising interest rate cycle.
Well, you've talked about some fixed income alternatives that sound like they've got some generous and very attractive interest rates that could be kicked off of a portfolio. Let's dive into a few of those because first you mentioned treasuries, and the 10-year and the 30-year treasury right now are offering very attractive rates. But even that, I've heard, could be a double-edged sword. On one side, yes, we can get those interest rates from something that is backed by the full faith and credit of the U.S. government. Hopefully, that's still kind of the gold standard of safety for quite some time to come. But on the other side, Chris, I've heard that the rates are rising and so attractive because internationally the world has decreased their appetite for US debt, maybe indicating that there's a less aptitude for thinking that the US will continue to be able to pay these rates for a long time.
Sure, yeah. And a further example of that is the US government helping to support the Japanese yen's value, which was almost at a 40-year low. And if they got a run on their currency, they would have to sell US bonds because Japan owns more US bonds than any other country on the international scale. And they would have to sell those bonds, which would push up interest rates even further. So, there is a lot of dynamic when you're buying bonds from a country or even a company that's heavily indebted is, the default risk. And I think everybody listening to this show today shakes their head at 38 to 40 trillion dollars in debt and no answer in sight because both sides of the political aisle can't get anything done, unfortunately. And
So are
I'll leave
treasuries
it at
still
that.
safe?
Yeah, the U.S. government, our gross domestic product and, the pace of our economy can handle the debt load right now. It certainly got a lot harder after 11 interest rate increases because U.S. government bonds paying a 4.5% interest rate, for example, that's a hell of a lot more interest than when they were 1.5%. I'll tell you that. And then now we just had the tariffs that have, are on again, off again, and they're having to repay the companies that were paying the tariffs. That money's no longer in the treasury. So they're, the government side of things gets, certainly gets confounded with the geopolitical risk.
And we have to consider that as we are looking at how to structure the portfolio. And Chris, obviously, that's a don't put all your eggs in one basket kind of adage there, and guidance, I think, is appropriate no matter where we're at or what we are investing in. But again, you've got several different alternatives for this fixed income side. You mentioned structured notes as well. Those sounded like they were offering a very attractive interest rate, but there is some risk involved there also, right?
Yep, everything's got risk in it. A CD has risk that the interest rates are going to rise and it won't keep up pace with inflation. We use a lot of what we call structured notes, and they're structured around the performance of the S&P 500, the Nasdaq, the Russell 2000 are three very common indices that these products are structured around, and the volatility of those. And, so those are very common to pay, high single digits to mid double digit interest rates. There's a couple different versions you can look at. And a lot of times we use a mutual fund that has these made up inside of them and use them for income. So we're trying to get a somewhere in that 10% range of an interest rate payout on a monthly basis. And I mean, 10% interest rate over the course of a year, but the interest gets paid out monthly and very good income generating products. So if you're looking for income, there are a lot more areas for you out there. And even on that short-term space, that CD renewal piece that's going on right now, or the money markets with all the excess cash in them is, I mean, we do short-term fixed annuities that pay a fixed interest rate, more tied to the bond market rates than it is the Federal Reserve rate. So right now we're getting, 2 and 3 year fixed annuities at 5%. So, that's pretty good for short-term dollars, tax deferred. You don't have to pay any tax on it until you take the money out. So, good alternatives to some other traditional investment pieces out there based off liquidity and what everybody's looking for.
As we've been talking about fixed income here, though, Chris, you've mentioned inflation several times and how that can be a risk to this fixed income component. Inflation sort of the enemy of fixed income here, it sounds like.
Yeah, inflation is the enemy because that brings the interest rate risk to that. If your bond is paying less than the rate of inflation, chances are you may have, if you want to get out of it, you have to sell it at a depressed price. And what I mean by that is, let's say you bought a bond, a 10-year a 10-year bond, doesn't matter what kind it is. It's paying 4% interest, okay? And then you want to sell it in year number five, but interest rates have fallen, okay? Well, heck, you probably get more than $1,000 for it because you're paying a premium to get that interest rate. If interest rates are now on new bonds being at 6%, you would have to sell that bond at a loss so that the yield matches what a new investor could get by putting in $1,000 to get 6% interest. So, I know these are inverse relationships and some of the stuff's hard to take when you're listening to it. We have
Well,
some visual pieces that tackle.
I'm sort of likening it to buying a house, Chris. Like if my budget was $2,500 a month back when interest rates were 2%, I could afford a much larger house. But as interest rates rose, the amount of house I could afford went down, right? That's kind of the same inverse relationship you're talking about here with fixed income.
Yeah, you're absolutely right, Peter. That's a great analogy right there. And, that's where the interest rate environment affects mortgages. So, which also affects the housing market. So these things do, there is a cause and effect to all of this beyond just the portfolio.
When we're talking about fixed income here, though, like income that we want to generate from the portfolio, maybe to go back in, but at a certain point in time in retirement, probably to take out and live off of. Chris, does it make sense to have multiple sources of fixed income? Like, I'm sort of thinking of Social Security is almost like one form of fixed income. Pensions would be another form of fixed income. And then in our portfolio, we've got to find a few more. Does it make sense to have a diversity or maybe even ladder them out in some way?
Yeah, without question. People ladder out CDs. We can ladder out bonds. We can ladder out annuities. We can ladder out the structured notes. So, a lot of different ways to, accomplish the goal, but use a lot of different tools to do that because, you don't use a hammer to pull your tooth out. So
No,
if you
please.
have, yeah, if you have more tools in it, and Peter and I are hockey fans, so we probably could say a hockey stick, but that's all right. We'll let it go.
It might have happened a time or two before. Certainly a puck. Chris, you mentioned annuities. How do annuities play into the role of fixed income or compare to other fixed income alternatives right now?
Yeah, well, an annuity can also have a structured payment system that's going to give you a set amount of money for the rest of your life. So, that's a nice diversifier as well. But like I was talking, I mean, right now you could probably go out and buy a 5 year fixed annuity with someplace in between 5 and 5.5% interest and just, put down $200,000 and generate the interest and take the interest and keep your principal nice and safe. You'll have reinvestment risk after 5 years. Where is the interest rate environment? Because then they can adjust the rate. So, they play a nice role in a portfolio to help diversify against direct stock market risk. You have the index annuity space, which, can still give you that reliable income, but also give you some potential to get some stock market gains in there without stock market loss. So, all these instruments today, Peter, from money markets to CDs, to bonds, to structured notes, all generate, income. We could include real estate in here as well. A lot of people have rental properties or, real estate investments in their portfolio. Lots of different ways to look at generating income, and diversity is certainly typically in everybody's best interest.
Well, Chris, in the annuity space, I know there are different types. Like there's the fixed that has a set interest rate. There's the fixed indexed that can share in the gains of the market, and maybe we can pull those gains off each year, but they might not be quite as certain or guaranteed. And then there's the lifetime income benefits that can guarantee an income for life, kind of a maximum amount of guaranteed lifetime income. But maybe the principal isn't protected the same way as like a fixed annuity. So there's a variety of options there. And I guess my question is the protect the principal and live off the interest mentality still something that retirees could strive toward?
Oh, yeah, I think without a doubt, because who wouldn't want to do that? Look, I want to, if I can generate enough income off the portfolio, we can do what we want, and then we can leave the balance for our children, for example, or to pay for your long-term care needs if you didn't have any kids left over and you were, just going to self-pay your nursing home bill or something.
I suppose the approach would be determined by the amount of income we ultimately need, though, right, Chris?
Yep, absolutely. And, I have that mindset when I look at, Robin and I's investment portfolio. It's like, okay, what kind of income can I generate off of this? Is it enough, to meet our living expenses and whatnot? And, depends on how much debt people have. Are they still making mortgage payments and house pay or car payments? These are some things that help us define how we construct that portfolio to satisfy that income need.
Construct that portfolio, though, Chris. I mean, the income need. I think that's a perfect segue to my question. You've mentioned several alternatives. I mean, treasuries, CDs, structured notes, annuities, bonds, bond funds. The goal really isn't to build a bond portfolio. It's to build an income portfolfolio.
Yeah, yeah, without a doubt, and like we said, option strategies in there, we utilize, quite often with our partners here at Brookstone Capital Management. So, I would like to be able to solve the problem using a number of different tools than just relying on one, for example.
Yeah. But we've been talking with Chris McIntire Retirement Services, of course, Northwestern Ohio's resource for proactive planning guidance, advice, structuring your portfolio, ladies and gentlemen. If you've got questions, if you'd like to get your game plan for retirement put together, give them a call. They do offer the initial conversation, the first consultation, the strategy session and review, and the structure and design of your written plan, your game plan for retirement at no cost. So all you need to do to get that conversation and that process started is call 419-332-0532, 419-332-0532, or visit their website, McIntyreRetirementServices.com. But Chris, with all this conversation here today, I'm thinking just because we're talking fixed doesn't mean we're talking boring. There seems to be a lot that can go on here in the fixed income side of the portfolio.
Yeah, absolutely. And if you don't need all of the income, you can just simply reinvest it as well, which is nice. I have some investments in my personal portfolio that pay out nice dividends, and I just take that money and reinvest it in something else. So I get the reliability of the income, then I can buy riskier assets with it.
Well, it's a good time to look at it because higher interest rates mean higher yields for you, higher income amounts, ladies and gentlemen. So take a look at the fixed income side of the portfolio. It does not have to be boring. In fact, it can be a foundational component for the rest of the growth that we hope to achieve in the stock market. And that's what Chris McIntire can help you strike the proper and appropriate balance of in your portfolio, making sure that you've got both safety and protection and that foundation, as well as the opportunity for continued growth with that fiduciary guidance in all of the recommendations and the management that he provides. So if you would like to take him up on that offer, pick up the phone, give a call, 419-332-0532, 419-332-0532. Chris, always a pleasure having these conversations with you. Thanks for keeping us up to date and informed and educated on different financial topics, questions, issues, and concerns. As always, thank you.
Hey, my pleasure, Peter. Thanks everybody for listening, and may God bless America.
Tune into Chris McIntire's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. The notes involve risks not associated with an investment in ordinary debt securities. The securities are not bank deposits and are not insured by the Federal Deposit Insurance Corporation or any other governmental agency, nor are they obligations of or guaranteed by a bank. The securities will not be listed on any securities exchange, and secondary trading may be limited. Therefore, there may be little or no secondary market for the securities. Accordingly, you should be willing to hold your securities to maturity. The securities are subject to the credit risk of the issuing bank, and any actual or anticipated changes to its credit ratings or credit spreads may adversely affect the market value of the securities.